Welcome to Finance Secrets, where we uncover the hidden truths about the financial world that the banking system keeps silent. Have you ever thought that the money sitting in your bank account is actually yours? Imagine a day when that changes. Imagine if your money could be programmed to only buy food, never crypto, or even worse, expire after 30 days. It sounds like a sci-fi movie, but this is a very real debate happening right now regarding central bank digital currencies. This is the dawn of the CBDC era, and if the US launches a digital dollar, the global game changes forever. We must ask ourselves, is this the future of finance we want, or is it a trap disguised as convenience? Before you panic, realize that 90% of your life already relies on digital money for almost every single transaction. Your salary hits your account, you swipe your credit card, you transfer funds. These are just numbers in a banking database. However, there is a fundamental difference. Bank money is a liability the bank owes you, not money you actually hold. When you deposit cash, you are essentially lending money to the bank, trusting they will pay you back when asked. A CBDC is different. It is a direct liability of the central bank, just like physical cash, but in digital form. Think of cash. If I hand you $100, the transaction is settled instantly without any middleman involved. With bank deposits, the bank simply records a promise that they owe you $100 in their internal ledger. With a CBDC, the Federal Reserve itself would owe you that money directly, bypassing the commercial banking system entirely. The collapse of Silicon Valley Bank in 2023 showed us exactly why bank deposits are not always risk-free. In a crisis, commercial banks can fail. A central bank, however, can print money, making CBDC theoretically safer to hold. Let's be clear, CBDC is not cryptocurrency. It is not Bitcoin, and it is definitely not a stablecoin. It is a digital version of fiat currency, issued and regulated by the government, with no decentralized features whatsoever. It represents the state's attempt to upgrade money for the internet age while maintaining absolute control over its issuance. For the average user, the experience might feel exactly like using Apple Pay or Venmo, but the back end is different. Instead of your data sitting on a private bank server, your financial life resides directly on the government's ledger. This shift brings massive convenience but introduces a level of centralized control that has never existed in human history. To truly understand the risks and benefits, we need to break down exactly what a CBDC is in 3 layers. First, the definition. CBDC is digital money issued by the central bank. The Fed calls it the safest digital asset. It is considered safe because it carries zero credit risk compared to money held in private commercial banks. Second, there are 2 main types. Retail CBDC is for the public, while wholesale CBDC is for financial institutions. Retail CBDC is the most sensitive type because it directly involves regular citizens and their personal privacy rights. Wholesale CBDC is less controversial, used mainly for settling massive payments between banks and financial institutions efficiently. Most central banks are already exploring wholesale versions to make the back end of the global financial system faster. But retail CBDC is where the battle lies, as it opens the door for direct government interaction with individuals. Third, we must look at the design. There are 3 main ways a government can structure their digital currency. Account-based means you have an ID linked to your funds. This makes it easy to track bad actors. Token-based is like digital cash. Whoever holds the token can spend it, offering slightly more anonymity than accounts. The intermediated model is what the US is considering. Banks would still manage the customer service and wallets. In this model, the Fed doesn't hold your account directly, but the money is still a central bank liability. This design choice is crucial because it determines who sees your data and who can freeze your funds. Even with an intermediated model, the central bank could theoretically see transaction data if the system is designed that way. The trade-off is always the same. You gain digital convenience, but you lose the absolute anonymity of physical cash. This is why the debate is so heated. It's not just about money. It's about the architecture of freedom.
Proponents argue that well-designed CBDCs can protect privacy, but skeptics remain unconvinced by government promises. The technical architecture is still being debated, but the core concept remains: direct access to central bank money. Now we need to address a common confusion. Many people think the new FedNow service is actually a CBDC. Let's debunk this myth right now. FedNow is not a digital currency. It is simply a payment system. Think of FedNow as a new, faster highway built for banks to send money instantly, 24/7. A CBDC would be a new car driving on that highway. FedNow is the road, CBDC is the vehicle. Launched in July 2023, FedNow allows you to send money instantly, even on weekends and holidays. It solves the problem of waiting days for checks to clear, but it does not change the nature of the money. The dollars moving through FedNow are still commercial bank money, not a new direct liability of the Federal Reserve. FedNow is purely an infrastructure upgrade to make the existing banking system more competitive with apps like Venmo. However, critics argue that FedNow lays the groundwork and infrastructure that a future CBDC could easily utilize. Once the pipes are laid and everyone is connected, introducing a digital dollar becomes significantly easier logistically. So while FedNow is not a CBDC, it is a step towards a more digitized and centralized financial environment. This brings us to the big question: why are governments around the world rushing to build these digital currencies? There are the reasons they tell you in press releases, and then there are the more pragmatic, strategic reasons. The good reason is financial inclusion. Millions of people have no bank accounts but do have mobile phones. CBDC could allow them to participate in the economy without paying high fees to predatory check cashing services. Another selling point is cheaper cross-border payments. Sending money abroad currently takes days and costs too much. By cutting out the correspondent banking chain, CBDCs could make global trade instant and significantly cheaper. Governments also want to protect monetary sovereignty. They fear stablecoins or big tech currencies could replace national money. If everyone starts using a corporate coin, the central bank loses its ability to manage the economy effectively. Now let's look at the pragmatic reasons, the ones that grant the government unprecedented power and speed. During COVID, sending stimulus checks took weeks. With a CBDC, the government could airdrop money instantly. They could inject liquidity directly into the wallets of citizens with the push of a single button. It's also the ultimate tool against money laundering. Every single digital dollar can be traced from birth. Tax evasion would become nearly impossible. The IRS would have a complete, transparent view of all income. In a financial crisis, a CBDC could allow the central bank to prevent bank runs by limiting withdrawals. They could implement negative interest rates effectively, forcing you to spend money rather than save it. This level of granular control over the economy is a central banker's dream, but a libertarian's nightmare. This leads us to the biggest fear of all, and the reason this video is so important: programmable money. Imagine money that has rules built into it, rules that dictate how, when, and where you can spend it. Government subsidies could be programmed to only work for healthy food, blocking purchases of alcohol or cigarettes. Even more radical is the concept of expiration dates, money that disappears if you don't spend it soon.
China has already experimented with this in their digital yuan trials, creating money that stimulates consumption by force. Critics fear this could link to a carbon footprint tracker, stopping you from traveling if you used too much energy. Public figures like Joe Rogan and politicians like Ron DeSantis have loudly warned that this is a slippery slope. It shifts the power dynamic completely. Your money becomes a permission slip rather than your personal property. While central bankers deny they would abuse this power, the technical capability to do so would exist permanently. So where does the United States stand in this digital dollar game? Is it happening tomorrow? Jerome Powell has confirmed that the Fed is researching it, but has not made a final decision to launch. Crucially, the Fed has stated they will not proceed without enabling legislation from the United States Congress. Politics is the biggest roadblock. In May 2024, the House actually passed a bill to block it. The CBDC Anti-Surveillance State Act shows that there is significant political resistance to a retail digital dollar. So, a U.S. digital dollar is likely years away, stuck in research labs and political gridlock for now. But while the U.S. hesitates, the rest of the world is moving forward in a silent race. According to the Bank for International Settlements, over 90% of central banks are currently exploring CBDCs. Smaller nations like the Bahamas, Jamaica, and Nigeria have already fully launched their own digital currencies. The real giant is China. Their digital yuan, or e-CNY, is the most advanced pilot by a major economy. With hundreds of millions of wallets already opened, China is testing the system on a massive scale. They are using it to pay public transport, buy groceries, and even pay government employees in some regions. Europe is also serious. The digital euro project is moving into preparation phases with a potential launch around 2029. This creates a geopolitical risk. If the U.S. does not lead, other standards might dominate the global financial future. We need to distinguish the enemies. Who is the real competitor to the U.S. dollar in this space? Bitcoin is decentralized and volatile. It is an alternative system, not a direct replacement for fiat currency daily spending. Stablecoins like Tether or USDC are private tokens pegged to the dollar. They actually increase demand for U.S. debt. CBDCs are the state's answer. They offer the stability of the dollar, but with the technology of crypto. The real battle in the coming years will likely be between private stablecoins and government-issued CBDCs. For the user, the choice will be between the privacy of the private sector and the safety of the state. If a digital dollar becomes a reality, here are 5 direct ways it will impact your daily life. First, speed. Sending money to family or friends, even internationally, could become instant and nearly free. Second, banks might pay you higher interest rates to keep your deposits, fearing you will move money to the Fed. Third, privacy reduces. Your financial history becomes more traceable than ever before, ending the era of anonymous cash. Fourth, taxes becomes automated. The government will know exactly what you owe, making tax fraud extremely difficult. Fifth, the risk of policy overreach. If laws change, your money could theoretically be used as a tool for enforcement. CBDCs are not inherently good or bad. They are a tool. The outcome depends entirely on who holds the handle. This is not just about technology, it is about power. Subscribe to Finance Secrets to stay ahead of the curve. Goodbye.